Elastic has risen more than 20% after its report. What will cause them to rise even further? They have had significant increases following earnings. What else might occur that could serve as a catalyst? That's only a taste of where I think these stocks are headed, as the consumer model and enterprise AI developments clearly begin with Godfather, Vad Jensen, and Nvidia. However, if you look at the consumption piece and these LM models, you'll notice that earnings and overall growth are being understated by as much as 15% to 20% over the coming years. You have names like Snowflake, Elastic, and Mongo for this reason. Palantir and AI are certainly where it all begins, but this software phase is only the beginning. Okay, so what role does the concept of bond yields play in this? I have a question for you. I believe that back in 2022, we discussed bond yields and the strengthening dollar extensively. In actuality, the dollar is currently even stronger than it was when Salesforce and Microsoft issued warnings in June 2022. What role do those factors play in this trade? Well, see, that might be a disadvantage for money. We have to see if it holds true in terms of dollar strength. But I believe the difference now is that a lot of that is figuring into guidance. However, compared to what we're seeing from the standpoint of demand, we're in a very different situation now. Because of the role that AI is playing, we are witnessing the opposite of the tighter environment that was actually a major obstacle in terms of software. Therefore, I believe that even though you may face some currency headwinds, they won't stop you from talking about what I think is NASDAQ 20,000, and I think we'll be talking about NASDAQ 25,000 in the next 2 years. Once more, Elastic and Snowflake are your choices for us today. I also want to discuss deregulation and the possibility of some adjustments to the FTC and other regulatory bodies. Do either of these names benefit from that, or do they have no bearing on it? Given that Khan will be present at the FTC, I believe it to be bullish because it will be a big deal-making opportunity. These corporations, in my opinion, will launch an offensive. On the other hand, there will be significant M&A from both a strategic and financial M and a perspective. Software has underperformed as a result. However, I believe that in 2025, we will sit here and say, software is fire, because this is only the beginning of what I see. It is the AI revolution at 9:30 and 10 p.m. now. We're discussing $2 trillion in capital expenditures for AI. They were on the velvet ropes behind hyperscalers, Microsoft, and Nvidia, you know. Software is saying, let us into the party. This is the portion. This is the portion. All right, let me introduce our mystery chart. Palantir was the name. You recently increased your price objective for Palantir, which is enjoying a fantastic year so far. The street is now around $37. It's $75 for you. This stock has seen a significant surge. What will cause it to keep rising this high? As we can see from the bears and pundits, the haters will not stop hating. Regarding the software and use cases, they continue to underestimate. Nothing on the market, in my opinion, compares to what Karp and the team have accomplished at AIP. The enterprise aspect, in my opinion, is something that has the potential to generate billions of dollars in income in the future. When you consider the implications of this, $75 may seem like a lot of money. In 3 or 4 years, I look out. Is Palantir poised to become the next SAP, Salesforce, or Oracle? I believe that's what we're discussing, which is why, look, the bears will emerge from hibernation to discuss valuation. This is only the beginning of what I see as the chaos of AI. The incoming president's rhetoric regarding Taiwan is intriguing. He says that they will have to pay for their own defense, which means that Taiwan will likely purchase F-35s and Patriot missiles from the US to demonstrate that they are willing to cooperate. This will likely enrage the Chinese. This has been the existential threat to Taiwan, Semis, and possibly Nvidia the entire time, so you start to think about how it will all work out. If you require any other changes, please let me know. Let's greet you. Tom Lee, Head of Research at Fundstrat, Managing Partner, and CNBC contributor. Seeing you this Friday is a pleasure. Tom, welcome back. Scott, thank you. I'm glad to see you. I start here by pointing out that we are currently seeing the stock trend, with the S&P hitting 5,800 for the first time ever. However, based on your notes, It appears that you are becoming a little more cautious as the month goes on. Why? We're wary, but we told our clients to purchase the dips, Scott. We're cautious because, I know this is a pretty apparent statement, I believe investors want to see who wins the presidency after Election Day. In my opinion, we are currently in a phase where markets are merely sitting on the sidelines. However, 2024 has been such a successful year, Scott, that I believe the past 2 weeks have demonstrated that perhaps macro is reversing course at this time, and liquidity and all of this cash on the sidelines is actually the determining factor. Do you believe that we simply need to finish the election so that we can go on to what you still believe to be a respectable rally? Your aim, I believe, is 6,000 or so. Yes, Scott, the economy appears to be doing well, and the Fed is dovish, so there is a lot of firepower supporting stocks after the election. We're not in a recession, in my opinion. As a result, stocks have highly positive 3- and 6-month outlooks. Although there may be some hesitancy, I believe that China's government is finally beginning to implement certain policies that will help that region turn around. Naturally, the third factor is that, after 2 years, I believe investors who have been extremely conservative are beginning to understand that, the low levels of margin debt and the $6 trillion of capital on the sidelines need to be used at a time when the Fed is bolstering the economy. I believe that the other potential obstacles are those that may not fall under the political cycle, at least as it is commonly defined. They claim that valuations are overly stretched or rich. At almost 21.5, the S&P is clearly above its historical norm. Yields have increased. I believe they're still up a little bit more than many anticipated after the Fed's 50-point test, but you could argue that they're up for the correct reasons. Furthermore, is it a problem if the Fed proceeds with rate decreases a little more slowly and in smaller increments? The counterargument to that is, of course, why they would need to do anything at all. Because, as you just indicated, the economy is robust. Yes, Scott, with regard to all those things, I am aware that the S&P's aggregate number is used for valuation, but it is deceptive since, as we all know, the top 7 equities do have a higher merited multiple, and the median PE is not that much less expensive. It is about 18 times. However, given that the 10-year yield is actually a 25p/E, it isn't a bad value. Regarding the potential slowdown in Fed rate decreases, I believe that the Fed is on track to essentially normalize interest rates back towards neutral as a result of diminishing inflation pressures. Even while this week's CPI was a bit higher than anticipated, I don't think it really indicated that inflation was picking up speed again. Therefore, I believe that the Fed's trajectory toward 3% is quite positive for stocks. I believe we could say that the consensus is bullish at this moment, so let's hope we can all sort of agree. Because of the economy and rate reduction, most believe that stocks will continue to rise. Where to position yourself to capitalize on a market that seems to be genuinely interested in rising seems to be the main point of contention among the crowd at this time. Small caps may have the chance to make the largest jump between now and the end of the year, as you have clearly indicated. That's a contentious opinion because, those equities may perform worse if yields are high. The economy is slowing down somewhat, or there are concerns about it. The insightful analysis Ricky Sandler of Eminence posted on social media yesterday, stating that the best place to play offense, and he believes you should play offense, is in below mega-cap companies with intriguing earnings equity stories at mid to large cap, not mega, but mid to large. I found this to be interesting. He doesn't mention small either. How would you counter those with your arguments? We're on the same side of the market expansion line, I would say, and he believes that mid to large companies offer a superior risk-reward ratio for a number of reasons, including the possibility